This is the time to add crash protection. After peaking at over 37 in late January, the CBOE volatility index, the VIX, is now in the teens. The S&P 500 is at a record high. This is the time where it's cheap to hedge because no one thinks there's going to be a crash. At least the market doesn't. Maybe there will be, maybe there won't be, but at least this way you'll be protected if there is one, and it won't cost you that much. Let's look at a simple way to add crash protection. Here we'll assume that your portfolio is closely correlated with the S&P 500 for simplicity's sake. So the first thing we'll do is we'll look at the current price of SPY. SPY, of course, is the ETF that tracks the S&P 500. And on Monday, April 5th, it closed at 406.36. Next thing we'll do is we'll enter the dollar value of your portfolio. For this example, let's say you have a portfolio that's worth $500,000. We'll divide that by the current price of SPY, which we've already forgotten, so we have to go back and check it again. 406.36. Okay, that gives us 1,230 shares. So we're using SPY as a proxy for the market, and we're going to look and find the optimal put options to buy to hedge against a decline in the S&P 500. Let's go to the iPhone app version of Portfolio Armor to check that. So the first thing we do is we enter in the ticker symbol for SPY, and we enter in the number of shares. And then here, we enter the largest decline that we're willing to risk. You can enter whatever you like here. The larger the decline you're willing to risk, the less expensive the hedge. For this example, let's try 20%. And here you can use our default time frame to expiration, which goes out about 6 months, or you can pick any available expiration. But we'll stick with the default for now, and we'll scan for the optimal hedge. And here we're presented with the optimal put options to hedge 1,230 shares of SPY against a greater than 20% decline between now and mid-October. The cost here is $8,052, or 1.61% of position value. And that's calculated at the ask to be conservative. In reality, you can often buy and sell options at some price between the bid and the ask. There are a couple things we can do to lower that price potentially here. One is we can try rounding up the number of shares to the nearest 100 or the nearest round lot. In this case, that would be 1,300 shares of SPY. And we do that, and it looks like cost here is $8,021. Let's double check what that was last time. $8,052. So it lowers the cost slightly to round up to 1,300 shares here. That's about 1.52% of position value if we round up 1,300. The other thing we can do to potentially lower the cost, and let's note here the annualized cost, 2.89% of position value. We can pick a shorter time frame to expiration. Let's try June 30th and see what we get. And here, as you see, the initial cost went down to $2,054, or 0.39% of position value. And the annualized cost went down too, 1.67% of position value. So this is a way, if you're more cost sensitive, to lower the cost of hedging by going out a shorter time to expiration. The drawback here is If volatility goes up and it becomes more expensive to hedge, you're only locked into June 30th here, whereas with the default we showed, you've got protection locked in at a low cost, relatively low cost, out to October. In either case, it's something to look at if you want to limit your downside risk in the event of a crash or a bear market within the next several months.